So now the camera's on, we can start going.
Okay.
So I don't stand up for 2 hours. I'm getting old.
What page are we going to?
So we're gonna start on chapter 4, and it's gonna be okay. Let me get some glasses. Sorry, I'm getting old. Okay. Now, the rest of it should always be kind of like this, hopefully. And we're gonna go through, everybody has their books now. We're gonna go through the books, and I'm gonna point out to you the things that are gonna be on the test. In theory, you've all read the chapters before you come in here. Part 1 should be that's individual tax preparation. You guys should know that if you've done much tax preparation. If you haven't, this will still be a challenge to you. Okay, so part 4 starts on page 111. Okay, so what have we gone over? We've gone over what are the rules to be a dependent, what are the filing statuses, what are the different kinds of incomes. Now we're going to go to adjustments. In effect, we're going down the tax return like the old-fashioned 1040s before this year. So before this year, you'd have the name and the address, the dependents, then you'd have all the different kinds of income, then you'd have the adjustments. From your total income, you'd subtract all the adjustments. So we're now going to do the adjustments on chapter 4. Okay, first one is educator expense. What do you need to know? If you're a teacher, you can be a teacher, instructor, counselor, principal, aide, as long as you do 900 hours a year. You can write off up to $250 of educator expense, but you have to have spent the money. So if I'm a teacher and I only spend $100, I can only write $100, even though the limit's $250. If you're a married couple and both of you are teachers, you can each write off $250 up to $500. That's pretty simple. There's not a lot to tell you about that. Just basically, what are we talking about? Books, supplies, all this kind of stuff. Every teacher I've ever known spends way more than that in reality. They used to could write off, you get to write off your first $250 as an adjustment, and if you have other expenses, you could write it off under on Schedule A as employee business, unreimbursed employee business expenses, but right now you can't do that. Maybe till we hit about 2025. Or, depending what happens in the election next year, they may have another change or two on the taxes. They may not. It could be that it just gets worse. I hope not. Okay? If you go to the next page, 2012, one of the next adjustments you get to subtract would be health savings accounts. In a while, we don't use these much. So you're going to learn this for the test, and you're not going to use it much. Why? A health savings account, think of it like an IRA. You can put, oh, come on. Can you get by? You can sit. Yeah. Okay, there's a camera right here that's actually working. You can sit, or you can sit over there. You can move those books out of the way. Okay, we're just getting started. We're on chapter 4. We're on page 112.
Okay.
And we just talked about education. So the educator expenses, you know how each teacher can write off $250, and they used to could write off the excess on Schedule A, but that's no longer going to happen. So on the next page, we're going to have health savings account. A health savings account, think of it like an IRA. You get to put money into your account, and you can use it. You get to deduct it like an IRA from your income. So your income is $40,000. and you put $1,000 into your health savings account, and then you get to subtract the $1,000 from your taxes. So you'd only pay tax on $39,000. Then, if you take the money out to use it for medical expenses, you pay for your medical expenses, and you don't have to pay tax on that money. Who does that help? Anybody that doesn't itemize. Okay, what are the rules that go with this? You want to know these numbers. So for single people, $34.50. If you're over 55, it's $44.50. A family, $6,900. If you're over 55, $7,900. After you hit 65, you can't use this anymore. Another thing is you have to have a high deductible medical plan. Is everybody familiar with high deductible medical plans? All of this is not, we don't use this much in Hawaii. So let's just say you're on the mainland where they didn't pay for your health insurance for you or your family. You can get a high deductible medical plan. So let's just say they don't start paying your medical bills till it hits 10 grand. Okay? Then with that, in this medical savings account, you can get a lot of your medical expenses paid for. Now, if somebody like Bernie Sanders wins and he goes, we're going to have free medical for everybody, that'll change all this. But that's not a guarantee. I doubt that he'll even get close, but it's not my job. Okay, so what is the other health medical counts? Remember, you have to have a high deductible medical plan. If you're over age 65, you can't use this. Okay? And if you can't be somebody's dependent and have this plan either, but that's not going to happen very often. What else? One of the things, a little catchy questions. What happens if you only have it for half of the year? You still get to put the full amount in. That makes it a good deal. So you go to work for somebody and they don't provide you medical insurance, you could have one of them, even in Hawaii. I had a guy that did once. He worked for the government and he had worked somewhere else, started using the plan, moved to Hawaii, still had it, and realized that it wasn't really doing him a lot of good. So he waited till 1 year, had some medical expenses, took the money out. And after he got the money out, then he closed it all down. Okay, everybody good with this? This is something they always have at least a question or two on, so you need to read it at least. Self-employment deduction. So, if everybody knows what self-employment income is, so you have to pay Social Security and Medicare on your self-employed income. Generally, it's about 15.3%. You also get a deduction of half of that. So let's just say all our computers now do this for us in reality. So we never really do this anymore. But if, let's just say that we had $10,000 self-employment income, you'd multiply times 92.35%, which would be 92.35, and that is what you would do. You'd multiply times if you were paying the whole amount, it's was it 12.4 and 1.45? That's not right. 12.6. I've got it wrong. It's supposed to add up to 15.3%. 6.2, 12.4 is right, and 2.9. That's what I got wrong. So, 15.3%, okay? Now, this 12.8 has a limit all the time, and it changes every year. It should be about 100-something thousand this year. Are you gonna have to do this by hand? Maybe. I know they got me one year because I forgot to do the 92.35. I just multiplied 10,000 times 12.4 and 2.9%. These are all percents. The 15, and they had the wrong answer on there also, which was very rude of them. Does everybody get how to do this? Everybody seen it before? I don't want to do too much of the easy stuff. But okay. So, whatever your self-employment is, half of it you get deducted on as an adjustment. That's what this is about. But if you don't know how to get the self-employment tax, you won't know what half of it is, unless they give you the answer. They have this on page 113. They have it pretty much for you. Okay. Self-employed health insurance deduction. So if you are self-employed, you get to write off your health insurance that you paid for. Okay, so if I have to pay, let's just say my family and I, we pay $12,000 a year for health insurance. Oh, that's crummy. But we don't work for anybody, we have to do it ourselves. Then you get to write off that health insurance as an adjustment. Okay? Now, there's some rules. First rule, you can't write off any more than your profit. If I only made $8,000 profit, I couldn't, even if I paid $12,000 in health insurance, I couldn't write off but the $8,000. One of the other rules is if I'm eligible for health insurance from my job, I have a business, but I also have a W-2, and I could have had health insurance through my job, but I chose, I don't want to do that, I'll just pay for my own, then you can't write this off. If you can't write it off on the front page as an adjustment, you get to write it off on itemized deductions. Either way. Was that gonna help you? Itemized deductions are gonna get harder and harder for you to get to be able to use because they doubled the itemized deduction. Does this all make sense to everybody? So, you're limited to the income. So if I have a business and I pay $12,000 for my health insurance, but I only make $8,000 in the business, I'm limited to writing off $8,000, right? If I could have had health insurance through my other job, let's say I have a job also with a W-2, and I chose not to use it, then you can't write this off. In common sense, nobody that has a chance to get free health insurance is probably not going to pay $12,000 a year in health insurance. Any questions on any of this stuff as we're going through? Okay, alimony. Remember, they're changing all the rules for alimony. I don't know how many questions they're going to have about alimony this year because it's all changing next year. Okay, so this year, if 2018, while you're taking the test on 18, it's already changed for 19. But let's just go over just in case. If you have alimony, it has to be written in the divorce decree. It has to be cash. It can't be other than cash. It could be a payment that's part of the decree where you pay a third party. Let's say that I get divorced and I have my wife's a doctor and I have a bunch of medical problems, and part of the divorce is she will pay for my medical. expenses. That's an equivalent of cash. And so that could be a write-off, no problem. Payments for upkeep of property. Let's say that I get the house and I end up owning the house in the deal, but part of the divorce decree is she has to pay the mortgage and the property tax. Well, that's alimony. Okay? Most alimony is just flat out cash. Okay? Then medical expenses, let's say that we both own, so that was if I own the house. What happens if we both own the house? Then we would split it. The mortgage is $20,000, then $10,000 would be alimony paid to me. The other $10,000 would be would write it off on her Schedule A, her $10,000 in mortgage. Same thing with property tax. Half of it would be alimony to me for the half that I own, and half of it would go to her. Okay? Third situation. We have a house that she's living in, but I still own the house, and she gets to live there, but I own it. Then I'm paying the mortgage, I'm paying the property tax, then that's not alimony to her. I get to write the whole thing off on Schedule A, but I can't count it as alimony. Those are the three situations. Okay, when is not alimony? If the payer's spouse is not liable for payments after death. So let's say that we have an agreement that even though I die, I still gotta pay money, she has to still keep paying money. That's not alimony, that's something else, probably divorce settlement. Tenants in entirety or joint tenants, none of the payments are for taxes or insurance or alimony. Okay, and I've already given you, let's see, when we were here the last time, does everybody have these two sheets? Remember? Okay, in most of the years, they give you this as one of the problems. Maybe 1 out of 3 of you will get it, but you want to be able to know how to do this. We went over it 2 weeks ago. They've got it in here as Alimony Recapture again. It's the same. So just go ahead and make sure you can follow these 2 pages. And which is this one? The one that's the first number is 4,000, so it's 60,000, 40,000, maybe. Well, they've got 10,000, but it used to be 20. It was the same problem that we had in practice, they always had on the test. I think they might have changed that finally. But anyway, make sure you can do that. Okay, so you have an IRA, you put money into your IRA. A traditional IRA, you get to deduct as an adjustment on your tax returns. If it was a Roth IRA, you don't get to adjust anything. If it's a non-deductible IRA payment, you don't get to deduct. But traditional IRA, so what can they do? It's $5,500, okay? If you're over 50 or over, it goes up $1,000 to $6,500. If you have a spouse that doesn't work, you get to take another $5,500 or $6,500 for that spouse. But there's some rules that go along with this. Okay? So what are the rules? Rule number 1, you're limited to your income. So if my spouse and I both get $13,000, we add it together, but we don't make $13,000 of income, we can't write off more than our income. That doesn't happen very often, okay? If we put too much money into our IRA, what happens? If we put $14,000 and we were only supposed to put $13,000, that extra $1,000, we've got to pay a 6% tax on that until we take it out every year. Okay, they ask that a lot. What is the they'll say 6%. That's for excess contribution. What is it if you take money out of your IRA before age 59.5, that's always gonna be a 10% penalty. They ask that almost every year, or some variation of it. They'll either say, what's the 10% penalty? Or they'll say, what are the exceptions to the 10% penalty? And they'll give you 3, and one of them won't be an exception. So when is the 10% penalty? What age? 59.5. You guys should all know that stuff. You know, just off the top of your head, if somebody comes in, and they've got a 1099-R, it's got box 1 is, box 7 is number 1. That means there's a 10% penalty unless you've got a reason not to. Your computers will do all this for you, but you need to be asking your clients, there's a 10% penalty. Is there a reason why you took this money out? You know, maybe they used the first $10,000, they took out 10 grand, they used it to buy a house. They took out 10 grand, they used it for medical expenses above 7.5%. What are some of the other ones? First time home buyer, qualified education expenses. There's some others. Huh?
Oh, they have it.
Health and medical insurance above the 7.5%. Okay, so okay, next one, student loan interest deduction. How much can they write off for student loan interest deduction? $2,500. You need to go ahead. Question?
Oh, no, sorry. Hi.
Oh,
Sorry.
here. Let me do this.
Thank you. Yes?
Yes.
Okay.
Oh, can you move over though some, because there's a camera there that's taken by picture,
Oh, do
and
I?
there's a camera there that there's a lady watching from the big island. She's named Lisa.
Hi, Lisa.
There you go, great. Oh, wait, there's the one from last week. Okay, you're Judith, right? So, now we're just missing Albert and Gemma, who's never showed up. Rieko might be missing. Nope, never mind, you became. Okay, 1, 2, 3, 4, 5, 6, 7, 8. Got it. And I don't know if Gemma's gonna ever come. Okay, so higher education, what is it? Up to $2,500. If your income is above a certain amount, you can phase out. So you might want to know those. There's a bunch of these numbers that you just want to learn for the test. But you got to learn them for the test. Because after that, everybody want me to turn the air conditioner on?
Oh, yes.
We started off, we weren't that many people, now we're getting more. So they ask you a bunch of things that you go, well, you don't really have to know this because your computer does this all for us now. In fact, it's gotten a lot better with these computers. Okay, so single between 65 and 80,000, and they've got if you're married, it's between 135 and 165. So, and they've got how to calculate the amount of student loan interest if you're in the phase-out period. I'm gonna let you guys do this. If I do this for every one of these problems, we'll be here all night. But it's pretty easy. Let's say the phase-out's 15,000 and you're 1/3 the way through, then you're gonna get 2/3 of it. And if you're halfway, you'd only get 1,250. And so on. Okay, here's a couple the other above the line deductions, which are what I call adjustments. They were called adjustments forever. This is the first book that I call that's ever used the word above the line deductions. I've heard it several times, but I never use it. but it's still the same. Everybody got it? You understand when we talk about adjustments? Performing artist. This is one of those things that you might get a question on it, but it's like really very few people qualify for this. So you're a performing artist, you have at least 2 employers, you make it at least 200 was received from each of them, and your income is under 16,000. If you're living in Hawaii, you're starving. Okay. Okay, so then the next one is penalty on early withdrawal of savings. So you have a CD and you earn $10,000 interest on your $1 million CD. That's about 1%. But you took it out early. So you've got on that $10,000, they gave you a penalty. Okay, so the reason, what I'm telling you is that you got to put the whole amount of interest on, then you get to subtract the penalty down here. Everybody should have already know that. Does everybody understand what I'm talking about? So on your 1099 INT, there's going to be $10,000 interest in box 1, and then the next couple of boxes over, they're going to say penalty 1,500, we'll say. So you would put on line 8, if you did it this by hand, or in your computer, it would put the whole 10,000 as interest. Then on the adjustment sheet, it would put the 1,500 as the penalty. Everybody good with that? There's not much. Not much other. Archer medical savings account. This is the old. We talked about medical savings account about on page 12, 112. This is the old form, the same thing, but it's the old one. They don't use this much anymore. I don't know if they're going to even have a question on it, but the same. You have to be covered from a high deductible health insurance plan. Either you can put the money in or your company can put the money in. If you put the money in, you'd be able to deduct it as an adjustment. If your company puts the money in, you can't deduct it as an adjustment. So let's say that you have $5,000 in your medical savings account, and then you have $3,000 of medical bills. You can take the $3,000 out of the medical savings account to pay for your bills. You don't have to take the $3,000 out and actually pay for the bills. I take the $3,000 out in December to pay for bills in January. I might have already paid for the real bills, but that $3,000 I take out counts for those medical bills. Those medical bills then that you paid for with a medical savings account, you can't put on Schedule A as medical bills. You can't double dip for the same thing.
So where do you put the expense?
Well, okay, so
Could I ask a question first?
let's just say your total income is $60,000. And you have a medical savings account, either the Archer or the other medical savings account. And you put $3,000 in this year into your medical savings account. Okay? That's an adjustment. So that would mean your income is only $57,000 of your adjusted gross income. Okay? So now you've got $3,000 into your account. You got to subtract that $3,000 for your income, and so you pay tax on a smaller amount. You with me? The following year, you did the same thing. So now you've got $6,000 into your account. Okay, year 3, you get sick. You have a bunch of medical expenses. You pay for them because you have money in your pocket. You pay for, let's just say $3,000. Okay, you paid for $3,000 in medical. So at the end of the year, you take $3,000 out of this savings account that you've got. even though you've now written off $3,000, you used it for medical, so now your account, after the 3,000, is down to 3,000. But you don't have to pay tax on that. You in effect got a write-off, way better than itemized deduction. You got a straight write-off out of your income as an adjustment. You understand how that's a good deal?
Well, how does that show in your W-2?
It doesn't.
So you
Now,
have to do it yourself.
if your company had paid for it, it might show as an adjustment on your W-2. But it's not, it would, it doesn't show, if you're putting the money in the account, you write a check. You don't take it out of your income from your job. If the company is putting money in, they don't count it as income to you. They put the money in. Okay? So it's not taxable to you. If your salary was $60,000, box 1, 3, and 5 would stay $60,000.
What's the document?
Huh?
What kind of document do you get of the 3,000 that you have used?
You would have from the medical,
Yeah.
the account. Think of it as an IRA.
Okay.
And they give you, and every year they're gonna give you how much you got in, what you took out. If you took something out, I believe they give you a 1099, and I don't remember which kind of 1099.
It's not the same as the
It
fixed?
might be 1099 MSA. And then it would say $3,000 taken out. And if you used it for medical, you don't have to include it as income on your tax return. But let's say that you didn't use it as medical, you went out and bought yourself a new car. Well, then all of a sudden this 3,000 you took out, you didn't use it for medical. It's now 3,000 of taxable income, and I believe you got a 10% penalty. So they don't want you to use it to go buy new cars, or go buy yourself a bunch of new clothes, or pay for your kids' schooling, or whatever. It's supposed to be for medical. Yes, another question?
Are they use your network to log into internet?
No. I don't have, no, I don't have Wi-Fi service like that. You'd have to be hooked up to the computer. My son would have to, I don't even know the network name. I don't do computers. My son doesn't, he's not here. But Lisa's hooked up.
Sorry. So
Yeah,
the-
go ahead.
So the 3,000 that you returned for medical, would you ask for receipts? Or how
No,
would
the
you-
IRS, unless they audited you would not put it on your tax return. You don't have to do anything on the tax return.
How would you know if you're gonna get penalized? Or how would you know if you spent it on medical or not?
If they audit you.
On it.
Yeah, if they send you a little letter that says, hi, could you send us copies of your medical? I don't think it has to go on an 8606 or a 5329.
So if you see that and they bring in medical receipts.
You see that, you go, did you use this for medical expenses? And they say yes. Then what I would probably want you to do is just make a note. Client said they could get the receipts for this medical if they have to.
So what if you had additional receipts and said, I used this above that 3,000?
So their medical expenses were 10 grand, they took out only 3. The other 7 grand could go towards your Schedule A medical expenses.
You would need proof that,
I would take their word for it and say something, document, they told me they had $10,421. If they said it exactly at $10,000, I would are you sure? And go, quit giving me round numbers.
Right.
Add the receipts up, don't just guess. Do we have to worry about this all the time? Yes. Are there lots of people that just go, they look at the ceiling and go, yeah, medicals, we got 10,000. My mileage, 10,000. My charity, 10,000. And that's, yeah, that's not a good thing. I'm sorry. Distributions not used for medical expenses are $20,000, 20% penalty,
Yes,
unless made after age 65 or upon death or disability. 20,000. I said 10. I wasn't looking. It was up.
yes.
Okay, loss limitation. A taxpayer deductible loss is limited to the smaller amount of the following. The at-risk rule. Does everybody understand what passive activity rules, at-risk rules? At-risk rules. I invest $5,000 in something, a business will say, and I haven't made any money, then I have at risk $5,000. I can't write off. If the business lost 30 grand, I couldn't write off the 30. I'm limited to the 5. Okay? That's, and the next rule is passive income. What is passive income? Income where you don't have an active participation. Rental income is always considered passive income. All you really need to do is just read this. Are they going to have a lot of questions about that? Probably not. Passive income is where you're not doing anything. If you had if you have a business of doing tax returns, you're the person doing the tax return, you're not doing passive income. That's active. You can have all the loss you want. Okay. On the other hand, if you have a son or daughter and you want to set them up in a business, let's just say you want to set them up on a snow cone business, you're not going to work there, but you give the business 10 grand just to set them up. That's passive income. Then your loss is limited to your passive loss is limited to your passive income. So, okay. Real estate is always considered passive. There's some other special rules. Rental real estate, you've got a $25,000 limit. If your income is over 100 grand, you can only get a portion. So we're going to say you've got a loss of exactly 25,000. Okay, but my income is 125,000. Okay, and so it's over 100 grand. So the difference between 100 grand and 150 grand equals 50 grand. Okay, 125 grand is 25,000 over 100 grand, right? So that's halfway. That's why I did this, to make it easy math for me. This is 50%. So I can take 50% of this 25,000, or I could take 12,500 as a loss this year. Okay? After this year, then I have 12,500 of loss that I took this year, 12,500 that I will carry over to possibly be able to use the next year, depending on the circumstances. Does everybody get how that works? On the other hand, if my income was only 80,000, I could take the whole $12,000 loss this year. Okay? Now I could take the $12,000 loss from the 80, and I'd be down to 55,000. I'd probably get a pretty good refund. But who wants to have a rental property where I keep losing $25,000 a year. That's not such a good deal. Or, the same thing, I have a rental property, but I lost $30,000. I can still, the maximum I can take is 25. Okay, does everybody get that? Because that's the maximum. And we're gonna probably get onto rental property in part 2 a lot more. Maybe even later on in part 1. There's an example on page 121 that you guys can look at. A lot of this stuff here so if you have a passive activity loss, that's what this is. It's suspended for this year, or you don't get to use, if your income would be over 125,000, the whole amount of loss is suspended, and then it carries over to the following year. If the following year your income is still over 150,000, any more losses added to it. If you had a gain, okay, let's just say the following year you had a $10,000 gain. Well, it would unsuspend some of your loss up to $10,000, and it would reduce your suspended loss, but it would stop you from having to write up. You wouldn't have a gain. Instead of having a $10,000 gain, you'd still break even at 0. Okay. Another thing that can happen: you have your loss, and you've been carrying it forward for 3 or 4 years, and then you sell the property. Well, then that suspended loss is freed up, and you get to take all the loss that you hadn't taken. And that's a windfall profit for your client, and then you get to feel good because you just saved your client a bunch of money. What do you need to also be careful of? If you get a client that has rental property and has got losses, you need to go back and look at his prior tax returns to make sure that he doesn't have any suspended losses. And if he does, you put it in your software so that he gets credit for it. Everybody pretty good with that? Thank goodness for software. I've never dealt with this, but there's brand new, starting with this year, it's called excess business loss. If you have a loss for a single person of over 250,000, $500,000 for a married couple, you're going to be limited in some of your loss, and you can't take the excess loss. You will have to carry it over. I'm going to let you. Now, what happens if you do that and you have a net operating loss? Net operating losses starting this year don't go back. Does everybody remember how your net operating loss used to go back to the prior years? And then you could elect not to have it go back and carry it forward. Well, now you have no choice. It all has to go forward. And it's going to be limited to 80% of your AGI, I believe. Or taxable income, not AGI. Okay, does everybody understand? This is one of the easiest chapters. Those chapters that you've already worked on were probably harder than this one. But all of this stuff, for most people, everybody here that does individual tax returns, this should be your bread and butter. This will be the easiest. And this test will be the easiest for you. Or maybe part 3, because part 3 is such a, the book is only half as thick, half as many chapters, and not as much stuff. We're going to decide in the next couple of weeks whether you guys want to do part 3 before we do part 2, because part 2 is normally the hardest part. We have a couple of more people that, okay, use the same method last year. So you always they try to get past part 1, and if anybody doesn't understand, you call prometric.com. You need to set up an account in the next few weeks so that you sign up for your test several weeks early. We've still got at least a month or so before we're gonna get there. But you wanna get early and plan for it. What I mean by planning, so that you will have read all the chapters, done all the problems, at least in the book, and if you really wanna get ahead, you do problems out of the online. Besides the problems in the book, you also can go online to your account with Line. Has everybody signed up for that now? Say yes. Make me feel good. Okay, so that as you go through these chapters, especially if there's something you don't understand, you go in there and tell Glam, I want to do chapter 4. And you go get a bunch of questions on chapter 4. And probably it's going to be chapter 5 in reality. Because we're at the end of chapter 5, we're going to have fun. It's called the QBI. It's a brand new deduction this year that it gives me headaches. I've already sat through 2 seminars on this, and I still don't have it all down. So I don't think they're going to,
It's terrible.
It is. It's really complicated,
Uh-huh.
and the IRS didn't even come out with the final rules until about 4 months ago, after we'd already done the tax returns for them. Okay, so it will be challenging, but we're going to work on it. Okay, does anybody want to take a 5-minute break and go to the restroom? Yes. Anybody? This is a good time. This chapter is one of the easier chapters. A lot of the stuff that we just went over, there's just going to be a question or two, and it's not going to be really hard. One of the things that are going to be, you're going to have to know the educator expense of 900 hours, health savings account, 3,450. 4,450. You also have to have a high deductible health plan. If you're a family, you need to know 6,900, 7,900. Self-employment deduction. Basically read it. I can't do any more than that. Alimony. And remember, does everybody, did you get one of these the last time you were here? The reason I gave you this is I believe this is going to be one of the questions. They may not do it this year because this is the last year they're going to even have alimony as we know it. So they may, but they've always in the past had one of those questions. Oh, I didn't go over on the IRAs. Remember, if you don't have an IRA, there's no limit. You can always put money in there no matter what your income is. But if you're part of an IRA and you have an IRA through your work, or could have an IRA through your work, then there's a limit on your income to what you can put in. It's on page 116. If you're married and you are not in an IRA, but your spouse is, there's a different set of limits. Anybody else need to go to the restroom? Take a break? Nobody here smokes? Good. We're in the whole smoking office. Okay, one of the things I forgot is the phase outs for IRAs on page 116. You need to know those, generally speaking.
Which one is,
What's that?
which one?
Page 116.
We need to know the
The
numbers.
face out or the?
Yes, you do, and you need to know that if you're in between 63,000 and 73,000, that you could write off part of the money you put in. You can still put the whole amount in. So let's just say 5,500. But only a portion of it's deductible. The amount over the your income. Let's say your income was 68,000, halfway between 63 and 73. So you could only have as deductible half of your $5,500 if you were single. Okay? If for single, if you're not in a plan like a 401k plan at your work, your whole amount you can put in, no matter what your income is. If you're married and you don't have a 401k option at work, but your spouse does, well, the income is really a lot higher. You don't start phasing out till 189,000. You still have the 10,000 phase out, but it goes way higher. Okay, I forgot, I didn't get that the first time. So let's go to chapter 5. It's gonna be, this is stuff you should already know. This is itemized deductions. If you don't know itemized deductions, you haven't been doing tax returns for it. Okay, first one we're gonna say medical. I don't have it here, but there's a better on page 1, well, in 2016, it's 148. But in your Pub 17, they give you a big, long list of all the medical things that are deductible and all the medical things you can't deduct.
What page is that?
Well, on this, it's a different page on your Pub 17, depending on which year. This is 18. On the 2018 Pub 17 is on 161. But it's the same one as on the one from 2 years. This hasn't changed for years. And it just gives you a list, just generally speaking. So if somebody comes in and asks me a screwy question and I don't know, I just pull this thing out and go look instead of trying to guess. But at any rate, so there's a lot, mostly. So who can you write off medical expenses for? Yourself, your spouse when you're married filing joint, for your dependents, or for people that would be your dependents except they made too much money. So somebody that couldn't pass the gross income test as a dependent could still be your dependent for medical. Okay, who is that? Who are we, a lot? Let's just say you got your son is 26 and you're still supporting him. Okay, but he made $6,000. He's living at home, you paying his medical bills. He made $6,000, so he made too much money to be your dependent. But he only made $6,000. He's not really supporting himself. He just made too much because he's 25 or 6 years old. Tell him to go get a better job. All that aside, you can still have him as your dependent. And what does that do for you? So you get to write off his medical bills that you're paying. Okay, adopted child qualifies as a dependent of the adopted parents at the time of the medical services are rendered or at the time that these are paid. So you adopt some child and you paid his medical bills before he got adopted. Excuse me. He had a medical expenses before he got adopted, but when you actually pay the expenses, he's already been adopted, then you get to write those off anyway. Everybody understand how that? you can just more or less just read this as much as I do. So, what kind of medical services can we write off? Okay, you get to subtract 7.5% of your AGI, and you add up all the medical bills, medical insurances, drugs, doctor bills, all the different kind of things. Everything that's over 7.5% of your AGI, you get to write off. So what are we talking about? Diagnostic care, there's a whole lot of lists. Medical insurance, they count qualified long-term health care premiums, smoking cessation programs, prescribed drugs, not drugs that are just over-the-counter stuff. So what would that be? Not Excedrin or that kind of Advil, that kind of thing. Your like vitamin A, B, C, D that you just buy at the counter.
I have a question.
Go ahead.
So your son that made too much.
To be your dependent,
Right, so he files his own tax return.
he would.
Yes, and then how do you claim this?
You claim the medical bills as part of your medical expenses. You don't have to claim him. You couldn't claim him as a dependent. And it happens with your parents more than anything. Your parents have a pension, $10,000 pension. You can't claim them as a dependent, but they live at home with you, you support them, they only get $10,000 as a pension, and they might get another $10,000 as Social Security, but they live at home with you, you pay for everything, their medical bills are a bunch of money, you can still write that off. If they're getting close to 20,000, you better be making pretty good money yourself. But if you're making 100,000, you own a home, they live in your home, and depending on if you got a home in Hawaii, that's an expensive right there. If it's just you and your mom living together, and you've got yeah, you have a $3,000 mortgage, you're already almost taking care of her more than she's taking care of herself. Okay, so all the kinds of expenses. Professional would be all the doctor bills, all the dentist bill, all the eyeglasses bills. The eyeglasses, if you had to have something, they had to have an arm or a leg put on, all that kind of stuff. If you had to do something for your house to make room for them, you had to put a ramp up your house, you could write that off. And things like that out of the elevator in your house. Because the example is, your doctor told you they had to have an elevator because you have a heart attack. Can't be going upstairs. The rule is, the cost of whatever you're buying for the house, the difference between that and how much it increased the value of your house. If your house was worth $500,000 and you put an elevator in there, and because you did that, your house became worth $10,000 more. But the elevator cost you $25,000. The difference between the $10,000 your house went up and the cost of the elevator, $15,000, you get to write off as a medical expense. That's a lot of times that's a question. Some variation with that. Probably not with all the round numbers I do. Okay, what are the things else you can write off? If you go travel, you have an airline ticket, and let's just say I went to Mayo Clinic to get them to check me out. The airline ticket that I went over there, I could write off. How about the food while I was there? Wrong answer. No, you can't write the food off. How about the hotel that I stayed in? I can write off up to $50. Well, if somebody came to Hawaii to get medical expense, they can't find a hotel for $50. But okay, so the rule is for the test, you could write off your airline ticket, you could write off your hotel, $50 a person. So if you had to have your, I was a 10-year-old kid and my mother and father had to come with me, that would be $150. $50 per person. Okay? Then if I came by myself, $50. I can't write off the food. What happens if I had to buy a car? Rent a car? If I just went over there in my own car, what is it, 14 cents a mile? It's something really bad. No, 18 cents a mile. 14 cents a mile, what is that for? Charity, I think. So 18 cents a mile, that's not very good. If I drove from LA to Phoenix to go see a doctor, that's not very good. But what happens if I rented a car? I came from Hawaii and rented a car. I'd get to write off the whole rental car. There's no 18 cents a mile. It's either the actual or standard deduction. If I use actual, and I use my own car, I can't write off depreciation and something else. Okay? Does anybody have any, you get to also write off Medicare. It's like our insurance, your medical insurance. If you had to pay the medical insurance, and let's just say that you didn't work but 19 hours a week. You worked for some company that was keeping you to 19 hours every third or fourth week, so they didn't have to pay for your medical insurance. There's some rotten companies that do that here. So you don't have medical insurance through your company because they're intentionally trying to keep you from doing that. Then if you pay for your own medical insurance, you can write off all your medical insurance for you and your family, anybody you pay for. Everybody pretty much okay with that? Then Medicare, if you're like me over the age of 65, I've got Medicare and I get to write off my Medicare. The basic cost of Medicare insurance, Medicare A, is not deductible unless voluntarily paid by the taxpayer for coverage. The extra cost of Medicare B, and I believe C and D, also they count. Everybody good with medical? Any questions about medical? Okay. Taxes. Well, everybody knows that they passed a new law and that taxes are capped at $10,000. Okay? And they've got something called the SALT. I don't know what that acronym means, but state and local taxes. State and local. S-A-L-T. Okay, state and local taxes. So you're limited at $10,000. So we're going to start with real estate taxes to begin with. So your state and local real property taxes are deductible. Your income tax, if you're in a state that has income tax, is deductible. And all of the taxes added together can't go above $10,000. So this next year, last year we didn't have a problem. This next year you're going to have to figure out, are your state and local taxes actually taxable if you itemize? In the past, you itemized and your state and local tax, everything was above the whatever the limit was. You had to add them back on line 10. So this year, maybe or maybe not, depending. Because we'll do that next year. Okay, so your state and local property taxes, you can write them off. What is the rule? Well, do you have to own the property? No. If real property is bought or sold during the year, you're going to have to write off a portion of it, right? But taxes are held in escrow and deducted when the financial institution pays them. So, if you've got a mortgage and the mortgage company is deducting for your taxes and insurance and escrow, even though they've deducted for them, if they don't pay them till the next year, you can't write them off. And they're going to give you a mortgage statement, and it's going to say this is your taxes. It may not be the amount they took out for taxes, it's the amount they actually paid. Is everybody pretty good with that? You get a 1099 mortgage statement, and they'll put your taxes down there. Your insurance, you're not gonna be able to write off. Okay, let's see. Taxes paid, service charges for police and firemen, usually you might be able to write off, but if there's a special assessment for local improvements that are added to your taxes, that's not property tax. That's added to the basis of the property. Does everybody understand what I mean? I live in a condo and they have a special assessment for whatever reason to fix up the condo. That's not the property tax. That's an assessment to fix up the condo. Or I live on a street, and in the street that I live on, the state and local government has a special assessment. That's not property tax. That's liable to be a question. That's been there for years. Personal property tax. State and local ad valorem and personal property. In Hawaii, there is no such thing as personal property tax. It's one of my little pet peeves. But a lot of people that use TurboTax, because in California, the auto registration fee is based on the value of the car and its personal property tax. So if you have a rich car, you have a brand new Mercedes that costs $70,000, your registration fee on that car is higher. In Hawaii, it's not done that way, it's weight. So you could have an old clunker worth $1,000 that's really heavy, and a Mercedes that's worth $70,000 that weighs the same weight, and you're gonna have the same personal property tax. Excuse me, the same registration fee. It's not personal property tax. So in Hawaii, it's not personal property tax. But if it's based on weight, it's not personal property tax. If it's based on the value of the car, it is. Everybody got that one? So when those people come in with TurboTax and they have personal property tax, you go, no, no, no. Or not. You can have foreign income taxes or deductible. Foreign income taxes can be either a credit, okay, using 1116, or you can have them as a deduction on your Schedule A. Most times it's better off to use them as a foreign tax credit, or that's my personal opinion. But you need to probably check both ways. If you don't get to write them off as a foreign tax credit, it might be better to take them as a deduction. You can have them, foreign taxes can be a deduction on your Schedule A. Okay, or they can, it's called 1116 form, and you can write them as a foreign tax credit. Generally, you get a better bang for your buck that way. Not always. Okay. Okay, foreign, non-deductible taxes, what? Federal income tax, estate tax, gift tax, inheritances. None of those you can write off. Well, what about sales tax? In some states, let's just say Texas, Nevada, Washington, they don't have state taxes, but they have high sales tax. I think it's 8% or more in Texas. It's pretty high in California, but they have. Okay, so they don't have income tax, so the people in those states get to write off their sales tax. They can either keep every receipt that they spend money on for the year and add them all up, or there's a formula that's on the IRS that tells you you live in California and there's 3 people in your family and your income is such and such, your sales tax is this. We have it for Hawaii. For some older people that don't have they don't pay state taxes, that might be better for them. But most people in Hawaii pay enough state taxes, it's always better to take state taxes than it is the sales tax. Everybody good with this? I don't have it in this room, but I have it in that room. I put up every year, I go make a form up, type it out, and put it by every computer so that every taxpayer can just look on the wall and see, I make $60,000, I got 3 people in my family, the sales tax is this amount. And so they can look on there, and if the amount of taxes that person pays is less than that amount, they can put that in there. All right? Interest expense, personal interest, never deductible. Okay? Investment interest, it's deductible up to investment income. If you have your investment income is $1,000, your investment expense is $3,000, you'd have $2,000 carried over to the next year. If the next year you didn't have any investment expense, but you had some investment income, you could knock off the investment expense against the investment income and lower your taxes. You get to keep carrying it forward indefinitely. Okay. Residential interest. What does that mean? Interest on your home. So on your main home, you get to write off the mortgage interest. What do you got to do that? Okay, starting in 2018, you're limited to $750,000 mortgage. If you had the mortgage before 2018, you were grandfathered in, you can have up to $1 million. Okay? But anybody getting a new mortgage, it's got to be $750,000. So if you have a main home and a vacation home, they both have to come up to $750,000. Or before this year, $1 million. Everybody good?
Mm-hmm.
If you have a home equity loan, the home equity loan, the same rule applies. You can only use a mortgage or a home equity loan on the house that you bought. Okay? Your main home. If you get a separate mortgage, you could use it on your vacation home. But you cannot, you used to be able to do this. I have a mortgage on my main home. I refinance, get a higher amount, and use that money as a down payment on my vacation home. You can't do that anymore. You can only write off the mortgage interest on the main home if it's for the main home. You can only write off the mortgage interest on your second home if it's for that second home. What happens if you have a third home? And you can't write off the mortgage interest for the third home. You might be able to write it off as an investment, limited to your investment income. I have somebody that's from Hawaii that she has just now got a third home. And I did her 17, she didn't have it, but when we get to the 18, I've got a little surprise for her. I haven't finished the technical yet, so, but it's got to be, and I looked up, when I started reading this today, I go, oh no. She's got 2 different homes in 2 different places, and she has her kids living in there. They're not rental properties, the kids aren't paying for them, they're just her personal homes. Now she went over to, she was living with her boyfriend. She's now went out and got her own place that she's living in. It's her main home. But now she has 3 personal homes.
And they're all financed.
And I believe so. So one of them, whichever has the lower mortgage interest, is she's not going to be able to write off again this year. None of them are rental properties. Okay. Okay, a qualified residence is the principal residence of the taxpayer and any one other residence. Any one other residence. Okay? Owned by the taxpayer and used for personal purposes for the greater of 14 days. So, we have this happening all the time. Your parents own the home, they've got the mortgage, but they're retired, and you and your wife and kids, maybe even your brother and his wife and his kids, are all living in the same home, and the two brothers, our brothers and sisters, are paying the mortgage. The parents don't pay the mortgage. What do? There's some, it's not in here, but there's special rules. If you're on the mortgage, if you can get on the mortgage, even though you're not on the title, you can write off the mortgage interest. And I can't tell you that off the top of my head. I've used it before, and I had to go to a research department to show me how to do it.
Something like if you're living there as your home,
Yep.
there's all these conditions about it.
Yes.
Living there.
Okay, that's not for this class right now. Generally speaking, you gotta own the home to write off the mortgage and the property tax. You can't be your parents' home. Okay, so everybody got that one? What happens if you have, if you use the place for less than 14 days? Then it's not your personal home. What happens if you rent it out for less than 14 days? It's not a rental property. That key is 14 days. When you get to the 15th day, your house turns into a pumpkin, and it gets really complicated. We'll get to that in another day. Okay, so you have a mortgage. You refinance, or either way, you have a mortgage. It has to be to buy, build, construct, or substantially improve a qualified residence. You have a second home, has the same rules. You can buy, build, or improve. Okay? You can't use any of the money for house number one, your main home, for house number two. You can't refinance for that. You can't use any of the money to go buy yourself a new Corvette, go send your kids to college, go on a vacation, pay off your credit cards. That you used to could do up to $100,000, but no more. Everybody good with all this? This is part of the brand new rules, is why we're going over this. Otherwise, I'd assume you guys already knew the old rules. Home equity indebtedness is all debt other than acquisition debt that is secured by the qualified residence. Okay? So you can have all kinds of different. So you have, let's just say you have net investment income of $10,000. Okay? And you have deductible investment expense of $3,000, your mortgage or your investment expense. You have a home mortgage of $12,000, then you could write off $15,000 as interest. On the other hand, your investment income is $8,000, but your investment expense, the interest on your investments, is $10,000. You're limited to the $8,000, and you would carry over the $2,000. Everybody good with that? They're going to probably have that on there somewhere. So if your investment income is less than investment expense, you're limited. It would carry over, I think, forever. How about points? Is everybody here familiar with points? If it's your first house and you're getting points, okay, and they fit all the little rules, the loan is to buy, build, or improve the house. Points are either, they're designated as points or loan origination fees. They're a percentage of the loan. They're established business practice. And they do not exceed the points generally charged in the area. You can write off the points the first year. If you have it for a second home, a rental property, investment property, you can't write off the points. You have to amortize them, okay, over the length of the loan normally. Everybody good? Generally, points paid to refinance a mortgage are not deductible. Okay. Points paid by the seller are added to the basis. Okay, everybody good with any questions about anything? As we go along, guys, you ask questions if you got them. Charitable contributions, this stuff is pretty much the same. What is the big difference? If you give a cash contribution this year, you get to write off up to 60% of your income. Okay, normally it's 50, but right now it's 60. I don't know if that's just this year or that's going to stay this way. So that's for cash.
This year, what?
2018. So if I made $100,000 and I gave $70,000 to charity, let's say you have this little old lady that's a millionaire. She puts her money in the bank, doesn't worry about it. She makes $100 grand just interest. Okay? And she gives it to her church. She gave $70,000 this year. That's more than the 60% limit. So she could only write off $60,000, and she would carry the other $10,000 to the next year, and depending on the circumstances, write it off then if she didn't go over the limit. How many years can she keep doing this? 5 years. Okay, this is stuff that's very likely going to be a test question, the 5-year part. How long can you carry over? She gets to keep carrying over 5 years. But she uses up that first 10 year, you'd use it up next. Okay? So next year she would use her 10,000 up. Yes. Not many people fit in that category. I did have somebody that did. They took a bunch of money out of their pension and gave it all to their church. My jaw probably dropped. They had to carry it over for 2 years. That is amazing. Made me feel bad. I don't do anything like that. Okay, so what are the rules for charity? Now, all these rules pretty much are the same. If it's under $250, you gotta have something to prove it. You can have, okay? But you can't give cash away and not have a receipt. Okay? If you give money and you up to $250, you can have a bank statement that get it. Other kind of statements, anything that works out. After you hit the 250 threshold, you've got to have a statement from the charity saying, "Thank you very much, Mr. Smith, for your $500 donation in cash. You did not receive any gifts or other stuff for this." Mahalo. Okay? Now, and you have to have it before April 15th or before you file your tax return. Will they get picky on that? Not so much. Is a bank record alone is insufficient on the 250 rule. You need something from the charity. Under 250, you just need some proof. you could give 10 $300 gifts. No, not 300, $200 gifts. They're under $250. Then you would need either a canceled check or just something from your bank account, and that would cover it. If it went over $250, you need something, a letter from the charity. So we have a lot of people that give a lot of money away to church here in Hawaii. Okay? They need to have a statement before they file their tax return. They can't come in, look at the ceiling, I gave $10,000 to my church. Show me. And they go, oh, I didn't bring it. Okay, well, we're almost done with your tax return. When you get back in here with that statement, we'll file this. Or you go, I'll just trust you. And you better document it. Does that make sense, guys?
It's never good to
Huh?
give cash to the church if you want.
Giving cash to the church is not a tax deduction unless they give you a written letter. No matter, you understand, you can't put money in the plates anymore. Just putting cash in there, that's not a tax deduction. If so, you go, well, there's no envelopes. You write your name on the envelope, put the money in the envelope, and they'll have a record. Okay, there's 50 on charities. There's a 50% limit, and then if you give a capital gain asset, so and you give it, so you purchase an asset for $1,000. It's now the fair market value is $5,000. So you give it away to the charity at $5,000. You can do that, and you give it away at fair market value, not at basis. If so, you could be limited to 30%, in some cases 20% of your AGI. So if it was worth $5,000, but your AGI is $100,000, even at 20%, that's $20,000. So you're way within the limit. Does everybody understand how that works? It's all here in writing. There's nothing I can tell you that you can't already see. Services, you can't give, I go out and work all day for my church. My value, my time at $1,000, and you can't write off your services. On the other hand, if I go do something for the church all day and I bring a bunch of materials and give them to the church, the value of those materials you can write off. Everybody good? This is common stuff. Charity, you can only write off 14 cents a mile. So if I had to drive from here to Waianae and back, maybe even Nanakuli, 50 miles, I could write off 50 miles times 14 cents, or like $7. Yeah, wouldn't be getting much. Okay, what other kind of itemized deduction? Personal casualty losses. So, what did they do about personal casualty losses? They said only personal casualty losses that are a nationally declared disaster. So, Kauai, when they had all the flooding, Big Island, when they had all the hurricanes last year, both of those counted. And I think out at Hawaii, on the road to Hawaii, they had a bunch of flooding. And I don't know if that was, I know the other two were, I don't know if that one was. But what happens if you lose a bunch of stuff, your house burns down, but it's not a national disaster? Pardon me. And you have no insurance, you just lost a bunch, and you can't write it off. Somebody breaks in and steals your car. Nope, no good no more. And everybody, okay, so what are the limitations? They're pretty much the same. It's $100 per incident and 10% of your AGI. As long as it was a national disaster. So that wouldn't help you if your car got stolen, unless it got stolen in the middle of a national disaster. Okay, so let's just say that we had a big flood, and it's a national disaster, and it wiped away your house. Okay, so if you had no insurance, it would be the whole amount, either lower of fair market value or basis in your house. If you had insurance, it would be the lower fair, it would be the difference between your loss. So if the house had a $300,000 basis and you got reimbursed $250,000, the difference between the two would be a $50,000. Then you would subtract $100 and 10% of your income, and that would be your loss that you could have on your Schedule A. On the other hand, what happens if your house had a basis of $300,000, but they gave you $400,000? Oh, that's a good deal. But you would have a gain of $100,000. That doesn't happen so much. I don't think those people over there on the Big Island that got wiped out by the lava got much of that. I don't think that a lot of them couldn't even get insurance, and so they didn't. I had a couple that came in during tax season just to ask questions. They never got their taxes done, but they lost. They had a rental house and their personal house, and they had no insurance, no coverage. So I'm not sure what they did.
Sorry, so,
Okay.
Hank, how do you prove the value of fair market value or replacement, or how do you
Okay, it's the
determine the
lower
loss?
of cost or fair market value.
So the cost to replace everything, so you keep all the receipts, or the lower of fair market value.
Yeah. Or, so what you bought the house for plus the improvements, if you could, I would write all this stuff down. You actually, if you've got something that all of us need to do is probably take our house and go take a video camera around and go through the rooms and show a video camera. This is what my house looks like. This is the stuff I had in there. Of course, in my case, they would probably just laugh at me. This is what you live like?
I was just thinking
And you
that.
want money for this?
I was just thinking that, no thanks.
Well, if you want them to give you something for it, you know, might be useful. Okay, so when can you write off these losses? You get to write it off. This is another question that's going to be on there, possibly. Somebody will get it. It's, you can write it off in the year that you have the loss or the prior year. How you write it off in the prior year? Because you've already filed that tax return. You amend your tax return. And it might be, let's just say this happened, you're not gonna file your tax, it happened in May. Well, you're not gonna file that next tax return for that year until a year later. But if you need the money now, you go back and amend your last year's tax return, especially since the rules changed, you might be way better off. Then we go to page 148, other itemized deductions. There's just a list of them. You just read the list and memorize it. That's about it. What is gambling losses? We see every now and then. Casualty and theft losses from income producing property, you can write off. Most of this other stuff you never see. Once in a lifetime at most. But you want to memorize them just for the test. And if I hadn't have just looked at them, I could have told you gambling losses, expenses for the impaired people, and I'm not sure I could remember the rest of them. You just don't, you don't see it in real life. Okay. Now comes my least favorite part of tonight. We're, huh? We're gonna talk about qualified business income deduction. Okay, it is brand new this year. Did all of, everybody that had self-employed people, anybody that had a Schedule C, anybody that had somebody with, a rental, with several rental properties, anybody that had somebody with, a K-1 from a partnership, from an S-corp, they would have had qualified business income. And in your software, hopefully you figured out how to do all this, or you got lucky and guessed. Okay? I'm gonna try to do the best I can. Nobody, except for a few people, I'm going to a 2-day seminar for NATP in September, the end of September, about the time you guys are gonna be taking your first test, or a little after. Hopefully we get, depends on how, if you guys are getting all this, you need to let me know and I'll move faster. If you're not, then I'll stay at this speed. Okay? So, they're gonna go, I'm gonna go take classes again on this same thing. Okay, so I'm gonna try to do my best to explain to you the best I can now. So there's a qualified business income deduction. It's a brand new deduction. 2018 was the first one. What is it? It's more or less 20% of your net income from a Schedule C, or 20% income from your income from an S-corp or a partnership. Okay? On S-corps, you don't count your W-2 wages. On a partnership, you don't count your guaranteed income, I don't believe. On a Schedule C, you do count your net income, and you get more or less 20% of that. Are there a bunch of little tricky rules? Yes. Will I be able to tell you all of them, which one? Nobody has ever been tested on this. We don't know what they're gonna do and what questions on the test. Lucky you if you took Part 1 last year. Unlucky you when you take Part 2 this year.
Oh, no.
Because this is gonna be on Part 1 and 2. Okay, so let's go and see what we got. Okay, Congress passed this, and one of the reasons they did it is why they gave a great big tax break to C corporations. We'll get in that in Part 2. They went down from the tax bracket of 35% down to 21%. That's a gold mine. It gets good to be rich.
No, but if you have a small corporation, the beginning tax rate started off at 50%. So for some of my companies, it went up.
Well, just be rich. Okay.
A lot of that.
So that's part of the logic. Why did they make this new QBID is what they call it. Qualified Business Income Deduction. Or I usually call it 199A. Okay, so there's two kinds. One is businesses that are service companies, and one is for businesses that aren't. If I'm manufacturing something, there's no limits. I get the 20% deduction. If I'm in one of these other ones, they call them specifically the SSTB, Specified Service, Trade, or Business. What would that be? That would be me, rotten creeps. That would be everybody that's in the business of accounting, law, service companies. anybody in health, doctors, nurses, that kind of people. Okay? If you have a business, that means a doctor, a lot of doctors are S corps. Very few are probably Schedule Cs, and a nurse that would be a Schedule C, most of them are W-2 employees. But there's some that way, okay? Performing arts, what would that be? A movie star that's incorporated. Consultants, athletes,
Movie star,
if you're, self-employed movie star. If they, okay. Then down below, it says who are not specified. Architects, engineers, real estate agents, and insurance agents. So those are the guys that don't. Those are service business and on. Remember, anybody in a business of manufacturing somebody is not a service. If you were somebody like a optometrist, you check people's eyes, but you also sold glasses in a shop. Well, then you would have an optometrist on this side. They would be subject to all the rules, but their business of selling glasses, maybe even making glasses, would not be, and it would have separate set of rules. And somehow you'd have to divide that up. That's not in this book, but that's happening. Okay, where are the lines? If you're a single person and you make under 157,000, or if you're a married couple, make under 315,000, you're not subject to these rules of phase out. On the other hand, if you're a single person, you make 207, or a married couple makes over 415,000, you're knocked all the way out. You don't get this credit. I hope I'm saying that right. And if you're in between those two, you have a phase out amount. And on page 151, there's how to determine it. I'm gonna let you read that. I couldn't tell you and be correct if I wanted to. Are you gonna have one of these where you have to figure that? I don't think so. They're not gonna be that tough. If they are, good luck. If I had the book in front of me, I could probably do it, and you could too, but just doing it out of your head, it might be luck. Okay, qualified business income deduction allowed per entity. So, let's say that you had 3 businesses, either 3 partnerships or an S corp or partnership at a Schedule C for that matter. There's 3 separate entities and you do it separately for each. But the limits, I think, the taxpayer's taxable income is divided in 3 categories. You got the lower limits if you're under 157. If you're between 157 and 207, then you're in the phase out, and after 207, you're knocked out. Aggregate rule: a business owner may own multiple businesses that are each separated legal entities. For example, the business owner has multiple gas stations. You can aggregate some businesses if they're all the same. You can't do that if they're service industries. So you own 2 or 3 bicycle manufacturing companies, you can aggregate those. But you can't do it if you're lawyers, accountants, and other guys like that. One of the family rules is that if you, your grandparents, your parents, your brothers and sisters all each own several businesses, and you get to 50% with the whole family, you can aggregate those businesses. I've never seen that in practice. None of this stuff that's in here doesn't show up in my practice. Okay, one of the things that's not here is what about the rule for rental property? The rental property rule, as of last year, you didn't have to have good documentation, they let you slide. So if you had 5 rental properties and you worked on all 5 of them, a total of 250 hours, you could use this and write off 20% of the net profit from the rental properties, or all together. So let's say 4 properties made money and 1 didn't make money, then you'd write off the net. It'd still come out. So, but what happens if you only had 1 rental property? You don't really work 250 hours a year on 1 rental property, so you probably couldn't use this. Starting this year, it doesn't apply for your test. You're supposed to keep records, just like you're supposed to keep a mileage log. You're supposed to keep a record of every time you work on a rental property. How many hours, minutes, or whatever did you work on it? Did you know, that wouldn't count. So, what are we talking about? Well, I spent 30 minutes doing the bookkeeping and putting it in QuickBooks. I spent an hour going over there repairing the toilet. I spent, an hour getting new customers. What you can't write off, though, is what I think is not fair, is the mileage going between those. You can write it off as a rental, but you can't count it as your 250 hours. So I drove my car to my rental property 20 times to fix stuff. I can write that off as a travel expense, but I can't write it off as counting the travel as part of my 250 hours. I don't like that, but they didn't ask me. Okay. What happens if you have a loss? You have to carry the loss over. Let's say the first year you get involved with this, you made money. The second year, you and all your properties, let's just say there's 1. Let's make this. So the first year I have a Schedule C. I made money. I took my 20% as a business expense. The next year, because of something that happened, I'm not making money. I have a business, and now the Chinese aren't buying my products anymore, so I'm going bankrupt. Well, I'll lose money this year. So you don't get a write-off because you lost money, but the loss you have to carry over to the following year and use that as calculations for your next year's amount. So I lost $10,000 this year, and the next year I make $40,000. I'd subtract my $10,000 from the $40,000. Am I positive about that? No, I think that's the way it works. Things that don't apply to this class that apply to Part 2 is deduction does not affect taxpayers' basis, such as if you had a AAA account in your entity, or I don't understand this. In addition to qualified trade and businesses, taxpayers can deduct qualified REIT dividends and qualified publicly traded partnership income. REIT is Real Estate Investment Trust. I don't know how that's going to work. I don't think you're going to get hard questions. What do you need to know? The rules about the 157 is where the phase out begins, and 207 is where it ends. Double that for married couples. Okay? You need to know that. 20%. You need to know that. You need to know who are the ones that apply to the SSBS, or whatever that SSB something, SSTV. Oh, sorry, that was a Freudian slip on my part. So you know that doctors, lawyers, accountants, performing artists, athletes. So an athlete would be somebody like a professional baseball player that also made money making commercials. All of that money, he would be in the phase out range. So if he made over $300,000, he was married, he made over, what is it? So, 207,000 as a single guy, he would lose out. He wouldn't get this credit. 207,000. Yep. So what? There's two classes: the guys that are in the SSTB class, and the guys that are doing other kind of things, manufacturing. They have a business where they do manufacturing, or I believe if they had a business where they were a limousine driver would even count. You know, yeah, that's not one of these. Consultant, performing, or this list over here. Remember the list that don't count: architects, engineers. So I believe if they have a question, they're going to say, which one of these is a SSTB? And they're going to put lawyers, accountants, athletes, and architects. And you're supposed to say an architect is not. Or they'll do it the other way around. They'll say architect, engineers, real estate guys, and accountants. Which one does not fit? Which one is an SSTB? Yep, accountants.
So real estate falls under the
They're-
manufacturing side?
Yes, they're not limited. And what does it mean? Remember these limits we have on the next page? The single people between 157 and 207, that's their phase-out range. All the other guys, the engineers, they can have any amount of income they want, and they get this credit. It's only the service people, doctors, lawyers, accountants, entertainers, athletes, they're the ones that don't get it. Okay, guys, is it easier now to go over this with the book? I hope. Make sure I do this myself. Make sure you, after you read a chapter, go over every one and answer all these questions. When you get to the point where you're going to start planning for taking the test, you want to go on the computer and make sure you hit all or as many questions as you can take without, going crazy. The other book had more questions than this. If you add all the computer questions, that's how many. We would have 100 questions per chapter, 70 questions per chapter, 80 questions. I like that. By the time you got through doing all those questions, you knew this stuff. Of course, they didn't have all this brand new junk in here either. All right, everybody good? Any questions? Anything you want to do? So let's do the next two chapters. Next week. Just kidding. Okay, so the next couple chapters. The first chapter is all the credits and alternative minimum tax. It's fairly, we got all the things. I think we're going to have child tax credit, earned income credit.
What chapter is that?
That's number 6. Number 7 is basis. It's one that's going to start separate the people that are reading the chapters from the not. Basis might be short. It depends. Basis. Okay, in the past, basis has been, this is really short. It's only about 6 pages of basis, but it's one of the most important chapters. And then the one after it is also going to be important. It is adjustments to basis, capital gains and losses, related party, business property, and installment sales. I don't know how much they're going to spend on this, but like-kind exchanges, partial like-kind exchanges, installment sales. I've got you little worksheets that I made out for you that I'll bring and give to everybody, especially for installment sales, so you'll be able to fit the numbers in the pukas, it'll all work. Part-time, lifetime, 1031 lifetime exchanges and partial lifetime exchanges, I'll have one for that too. So if you get it, all the capital gains, the gains and losses, everything, if you fill in all the pukas, it'll all work if you can memorize the whole formula. And no matter how they give it to you, it'll all be there for you. You'll understand the difference between whether it's going to be taxed as ordinary gain or capital gain, depreciation, recapture, all this will go, but it's not for a couple of weeks. Anyway, next week will be fun. All you got to, hopefully all you guys, you already know the rules for earned income credit, child tax credit. What are the other credits? Child and dependent care credit. Alternative minimum tax might be a little more challenging. But they're not, I'm gonna just show you, they're not gonna make you do a lot of alternative minimum tax. Okay? Everybody got one of these for the, May's the only new person this week, right? Okay. All right, guys, we got through almost 10 minutes early. In a couple of weeks, it'll be more challenging. It'll be next week. Hopefully, everybody knows all this stuff. Has everybody done earned income credit tax returns, child tax credit? Raise your hand and say yes. No. Okay. Then, if anybody has any questions or problems while you're reading it, call me. My life has gotten easier now. We're not. No problem.
Thank you.
All right. So that's what's first.
I was hoping to break down the QPI because I'm convinced about it.
Well,
And then everybody gets that 20%. It just seems like everybody still gets that 20%.
on your computer, my computer doesn't always give it. What software do you use? So do I. On Schedule C's, they're not getting it? Now, rental property, they don't. You gotta check those boxes. Same thing when you get to, S-corps and partnerships.
Oh, yeah.
Okay, bye, Lisa. Bye, everybody.